Good evening, everyone, and welcome to tonight's presentation regarding income splitting. We'll be starting in just a moment to allow everyone to join. I hope you're all relaxed and somewhere comfortable and ready to join us on a journey through personal finance tonight. This topic is exciting for people like myself and my colleagues, so I hope you will also share some of that excitement by the end of the presentation too. All right, well, I think we're ready to begin. Good evening, everyone, and welcome. My name is Chris Malloy, and I'm an advisor here with TMFD Financial. The TMFD Academy is pleased to present a series of webinars that cover a variety of topics, both clinical and financial. This evening, we're continuing the financial theme with a presentation on income splitting. Now, I find this topic always garners a lot of interest. The question is, why do we care about income splitting anyway? Well, because it helps us to save tax, of course, and who doesn't like to save a few tax dollars? So hopefully I've been able to pique your interest. Tonight, we're going to address the following objectives. Discover why income splitting is advantageous as a tax planning technique. Discuss different methods of income splitting. Identify opportunities for income splitting with your family, and to identify some common pitfalls to avoid. So in summary, we want you to be aware of these opportunities and take advantage of them wherever possible. So I'll be introducing our speakers in just a moment, but first I'd like to hand things over to my colleague, Jake Giesler, who's managing the technology for us tonight, and to provide some housekeeping items.
Thanks, Chris. Good evening again, everyone. Welcome to the TMFD Dental Academy. I want to take a moment to introduce myself. My name is Jake Giesler. I'm an advisor with the TMFD Financial team. And like Chris said, I'll be managing the technology this evening. So before we begin this evening's presentation, I just want to take a moment to cover a few housekeeping items. First off, we have a couple Q&A questions this evening. If you see, we have about a couple Q&A questions where there'll be a couple slides that come about, and it's just CE requirements, and we'll just have to go through that. And we're not trying to test your knowledge or anything. We're just a couple housekeeping items. There's also a chat in the chat box. If you have a question for me, just leave your questions in there and leave the questions directed towards the speakers in the Q&A chat box. As far as if your layout gets confused throughout the Zoom, in the upper right-hand corner, there's a view button, and you can set the view to whatever you like, whatever's your preference. Just if you get confused, that's a good way to correct your settings in your video. We also have a free book, The Financially Independent Dentist, coming out for whoever's new to these webinars. If you've been to a previous webinar before, you will not get a second book, unfortunately. But if you are new to the webinars, then you'll have a free book emailed to you or mailed to you.
If they ask very nicely, Jake, maybe they'll get another copy.
Yeah, we'll check our boxes.
You need one for the home and one for the cottage, maybe.
Yeah. And lastly, we encourage you to register for our TMFD Mailing Academy list so you can stay up to date with all of our webinars. I'll send a little message in chat here real quick where you can have a link to that. We're excited to grow this wonderful community, and we look forward to hosting many more webinars in the future. And our next webinar is on Wednesday, November 9th. I'll post that link in the chat box as well. But the full 2023 winter schedule will be finalized in the coming weeks. So just keep your eyes peeled for further announcements on our webinar lineup. And yeah, that's about it wrapped up for our housekeeping items. So Chris, I'll throw it back to you.
All right, thank you, Jake. And now I'd like to introduce my friends and colleagues, Stive Farronato and Zach Sloan, who are speakers for this evening. So first, I'll introduce Stive Farronato, who is the lead accountant at TMFD. Many of you on the webinar tonight know Steve as our grand poobah, if you will. and he is synonymous with the TMFD brand. As you can see, Steve has obtained his CA designation in 1992, his CFP designation in 98, and joined our team here in 1995. Now, prior to joining TMFD, Steve worked in public practice, but he also worked for a little while with Canada Revenue Agency, so he definitely has an inside track on how things work with our friends in Ottawa. And as you may have noticed behind him, Steve is a really big Toronto Maple Leafs fan. So Steve, I guess we're hoping for a better season this year, eh?
Always hopeful, Chris, always hopeful.
Always, yeah. Next, I'd like to introduce Zach Sloan, who is an advisor with TMFD Financial. Zach is responsible for maintaining client relationships. He draws upon several years of experience in tax, estate, and financial planning to help clients achieve their goals. Now, in his personal life, Zach pursued a baseball scholarship in the United States. And at 6'4", he is an amazing pitcher and competes for the Toronto Maple Leafs Inter-County Baseball League. So Zach, I guess you could say it's a competition to see which Leafs team, either hockey or baseball, will go further in the playoffs this year.
I think they're both. I think they're both chokers.
Yeah, we actually managed to win the playoff series, so we got to already starting.
Oh, burn. All right, so Zach, I'll turn things over to you to get us started.
Awesome, thanks, Chris. So, as Chris mentioned, my name is Zach Sloan. I'm an advisor with TMFD Financial. I'd just like to begin by thanking everyone for attending, and I hope you're all as excited about income splitting as we are at TMFD. Believe it or not, we actually enjoy this stuff. We get a kick out of crunching numbers. I know Steve does it better than anyone else, so you're going to be hearing from the best with him and myself tonight. Just an introduction of what we're going to be going through tonight. Obviously, I'll introduce what we do here at TMFD just quickly, and then we'll go into the different types of income splitting. We'll run through a quick overview of what income splitting actually represents, what the actual goals of income splitting are when we talk about these different strategies that we're going to approach. And then we'll kind of review everything at the end, through the different types of strategies that we talked about. And then try and see if there's any feedback from you, the attendees, and see if there's anything that you want to hear from us that we didn't cover. So for us at TMFD, our objective is just to make the financial lives of dentists simpler. We combine a variety of services under one roof. This includes tax and accounting, investing, financial planning, insurance. We also coordinate with dentists' other professionals, such as like lawyers, bankers, mortgage brokers. We really try and deliver an integrated approach and ensure that you only need one point of contact to resolve any financial matter that you might be dealing with. So as far as income splitting goes, it's a pretty simple task, pretty simple objective. You're just trying to minimize tax. You want to try and shift income from one family member who is at the highest rate and move it on to an individual, whether it be a spouse or perhaps a child who has a much lower tax rate, and really trying to avoid giving any more to Justin Trudeau than we have to. So the actual act of income splitting, as Steve will get into, is a lot more complex than the definition of it. However, when you're looking at the overarching goal, it's a pretty straightforward goal. Just move from one to the other as legally as we can and as effectively as we can. So easiest example you can give, you can earn a great salary of $200,000, but it will never quite cut it to a great spouse who can earn just as much as you can. So one person makes $200,000. Take home is about $11,000 a month. If you find yourself a spouse who can earn just as much as you, let's say you both earn $100,000, you can take home about $13,000 a month. So the best advice we can give here tonight is to marry well. This is the tax table that we'll just start off with. Obviously, I'm sure you know, dentists, you have your corporation. When you pay yourself a dividend, it comes out as a non-eligible dividend. However, any dentist who's further into their career, they have investments held within their corporations. Any taxes that you pay on your corporate investments They help to build up the tax credits, which help you to build up tax credits that give you eligible dividends, which are, as you can see, taxed at a much lower rate than non-eligible dividends. So we'll talk about more about corporate structuring and things like that. But effectively, what you want to think about is how you want to shift from the 53% rate down to the 20% rate of a spouse who's not working, or perhaps a child who's you're able to avoid attribution rules for, which we'll get into. So Steve, you can take it away.
All righty, thanks very much, guys. Appreciate the introduction. And Chris, always nice to get a few nice words about our friendly Maple Leafs. I mean, we could ditch the whole presentation and spend the next hour talking about the Leafs power play. Why isn't Austin Matthews scoring, and should we trade Willie Nylander? But maybe we'll save that for another time. There's a couple areas that we're going to go through tonight. I'll go through the first couple of points there. Then Zach will bring us home with some of the pension splitting and a bit of a wrap up. So I think we go to the first salary and dividends to family members. Zach, slide, please. All righty. Okay, so the two most common and typical ways of splitting income that most of us are aware and find ourselves have utilized in the last number of years since professional corporations have been established is paying either a salary to a spouse, to a child, to a parent, as well as potentially providing dividends to a spouse, parent, or child. The rules in which members of the family can be shareholders of a corporation are somewhat complex, but just to make it simple and easy, the ability to have a parent or a child, as well as a spouse as a shareholder, will provide opportunities within certain rules. From a salary perspective, the main thing is the reasonability test and what's considered reasonable in terms of giving a salary to a spouse, to a child, to a parent. And this is where the boundary is so wide. I have clients ask almost every day, Steve, how much is a reasonable amount? What is considered reasonable? And from my days at CRA, I can tell you it's a wide range. It's one of those areas that is sometimes overdone, and people tend to pay a little bit too much to family members. But it's an area that really, I believe, and from my years that I worked at CRA, isn't something that's generally looked at in such detail, especially if it's done such that the salaries that are paid, or whether it's an hourly rate that's paid, that is well documented, that is a T4 is provided at the end of the year, that withholding taxes are paid on payments, that you pay the individual on a regular basis, whether it's every 2 weeks, whether it's every week. You have set duties. If there are staff contracts that are in place with the rest of the office members, introduce that staff contract to your spouse or to your child, to your parents as well. So making sure it's well documented, making sure that you pay on a regular basis. Don't pay on a lump sum amount. Don't pay not through payroll and throw it as a management fee. Don't bring light to the situation at the end of the day. Do it such that it flows like any other payment of a salary. I mean, we've had people ask, can I pay my child $50,000? Well, how old is your child? Oh, she's 9 years old. What's $50,000 to a 9-year-old? Is that considered reasonable? I would tend to say that's not a reasonable figure. A 9-year-old is still in school, can't consider to be working on a full-time basis. So, if they're helping administratively, helping with filing on the weekends or after school, then, to pay a child $5,000 to $10,000 a year may be considered a reasonable amount. Things like Canada Pension Plan or unemployment insurance, when you have a family member, you don't pay into unemployment insurance because you can't lay them off. For a Canada Pension Plan, if they're under 18, you don't pay into the CPP program. Even if you pay a child $10,000, it's under the, I guess, the limits, the tax credit limit that you don't have to even pay any taxes. So, if you limit a payment of $500 or $1,000 a month to a child for administrative duties, I think that's considered a reasonable amount. So just follow the proper process. In terms of dividends to a spouse, child, or parent, it was open season up until I think about maybe 3-4 years ago, where Justin Trudeau and I'll give you a story. Justin Trudeau and even my daughter, who questioned it at the time. But I have 2 girls, if some of you know, and they're both of age as of now. But years ago, when my eldest turned 18, I came home that night and wished her happy birthday. And I said, honey, Dad's got a $5,000 check in his hand, and I'll give you that $5,000 check, but you have to give Dad $10 to buy shares in his corporation. And my daughter hemmed and hawed and said, Dad, that doesn't make sense to me. I said, hon, here's a $5,000 check, and all you have to do is give me $10 to buy some of these shares of Daddy's corporation, so you'd be entitled to a dividend. You know what, Dad? I just don't get it. It doesn't make any sense. I didn't do anything for it. All I have to do is give you $10 and I get $5,000. It doesn't make sense to me. So my daughter, the other daughter who was sitting at the table as well too, was 2 years younger. She reached out and took $10 out of her pocket and say, here, Dad, here's my $10. I want my 5,000. So she was a little ahead of her game, my eldest. So she probably spoke to Justin Trudeau and decided to bring in the TOSI rules and the tax on split income, where providing children, especially under the age of 18, as well as children over the age, or even adults, the ability to provide or issue out dividends has definitely been altered and changed. I mean, there is massive flow charts. If you ever Google TOSI flow chart, you will see a page long. It would fill this entire screen of different if-thens and questions that you need to ask to determine whether this income received is considered TOSI, and it would be ultimately taxed at the highest tax rate. The bottom line that I tell a lot of our clients, the safest option to receive a dividend is if the individual, whether it's a spouse, parent, or adult child, especially it has to be adult child, that they spend at least 20 hours worth of work at the practice a week. So whether that's 4 hours a day or a couple of full days, if the individual is providing at least 20 hours worth of documented work, then they are allowed to be paid a dividend. So I think the reasonableness, salaries, and the dividends sort of go hand in hand. If you are putting a spouse or a parent on as on a salary, and you're paying them at least 20 hours worth of work a week, then that dovetails nicely into being able to pay a dividend to a spouse or a child or a parent. So the two, to me, go hand in hand. Without getting a salary is fine, again, but you need to document that 20 hours worth of work was done and you decided not to pay a salary, but you want to pay a dividend as well. So I think you're always safe. You ultimately do a little bit of both, and this way you can achieve the ideal mix in dividends as well as salary. Next slide for us, Zach. As mentioned earlier by Jake, if you have questions, we're going to try to collate them at the end and try to ask them along the way. If you really have an urgent question that needs to be asked and you cannot wait, please do so through the chat. And I think Chris and Jake are monitoring, and we'll try to help you out. All right, so we talked about paying dividends to shareholders of a corporation. And when the structures of the professional corporations are established and you are dealing with a lawyer, and again, we strongly recommend when a corporation and a professional corporation is set up that you seek the advice of the professional of a lawyer. It's not mandated, and I know a number of people that have attempted to set up corporations on their own, and you can. The ministry takes a fee from you and you can go ahead and set up your corporation. But if you spend the extra dollars, coordinate with your lawyer as well as with an accountant, you can then ideally create a structure that will allow the flexibility to have different classes of shares. And as mentioned here, there are two different ideally classes of shares. There are your growth shares and your non-growth shares. And growth shares are shares that participate in the increase in the value of the company. So as the company grows, you initially start off your practice, there's not much growth to it or wealth to it because you've, say, taken on debt or you started opening up a practice from scratch. There isn't much value, but as time goes on, you build up some growth, and then ideally the shareholders will participate in that growth. As a non-growth shareholder, the individual simply has a class of shares that most likely will just pay them dividends. So if they have the 20 hours worth a week and you want to pay out a dividend to the non-growth shareholders, is as simple as paying that out. However, they do not participate in the growth of the company. And ideally, only the growth shareholders are the ones that are entitled to the large capital gains exemption. And this is still something that's available to every shareholder of a private small corporation, as well as your dentistry professional corporations. And the non-growth shareholders are not entitled to the capital gains exemption. So when you're setting up the share structure and you have the ability to have growth shares, and these growth shares can be both voting and non-voting. As you know, the main dentist or the owner dentist must have the growth voting shares. The other individuals, the spouse, the adult children, as well as minor children, and the parents, they can have growth shares, but they are non-voting. Make sure when they're established, you have different classes of shares so that each can participate accordingly. And with a $913,000 exemption for 2022, that's about a $242,000 tax savings. That's a substantial savings. And if you multiply that across a family, then that is a large sum of money that can be earned tax-free. But when you have participants owning growth shares beyond the dental owner, you get into other potential risks as well too. If you have a parent or a child owning growth shares, they in fact own the shares of your corporation, and that can't be taken away. So if and when the practice is sold or there's an attempted sale and the requirement is for all the shareholders to sell their shares, and you have an individual that may or may not be willing to sell, would ultimately cause an issue. And ultimately, the proceeds will need to be paid out to that individual as well too. So you come into situations where you have marital breakdown, there are creditors that are involved, children that marry and have spouses, potentially have a stake in those growth shares if the marriage does not go along favorably. So it's nice to be able to share in the capital gains exemption across the board and across family members, but you are giving up a bit of control from that fashion as well too. Next slide there for us, Zach. So this is a typical example of a scenario where we have a dentist owning some growth shares and the spouse owning some growth shares, non-voting growth shares, and they initially set up the corporation and they bought $100 worth of shares. It's always important when you are establishing these professional corporations and you're dealing with a legal professional, they'll tell you that it's important to fund the initial purchase of the shares of the practice with this $100 or the $10 or whatever you determine the value of the shares to be. So it's important to have the structure documented well and to show that you have in fact made the contribution for the shares. So in this particular case, we have the spouse and the dentist that own the growth shares, voting and non-voting. Practice was established a number of years ago, built up, and was able to get to a point where they were able to sell their practice for $2 million. And they were able to sell the practice shares and considered a share sale. There are two types of sales, share sale and asset sale. We won't get into that. The previous presentation that we did a number of months ago sort of went into a little bit more detail there. They're in our archive presentation, so if you want to go back and take a look, you could take a look. But in this particular case, on a $2 million sale, the no use of a capital gains exemption would have them pay tax at around $530,000. That's about 26%. If ultimately the corporation qualifies and you have the ability to utilize the capital gains exemption, there's a reduction of taxes down to a point where you're only paying about $46,000. So you're netting close to the $2 million in the proceeds net to you. There's a tax savings of close to almost $500,000. So that's a significant amount of savings, ideally making sure that the structure was done properly from the beginning. The drawback comes on the next slide, where you have maybe at the time the corporation was set up, you yourself as the dentist were the only shareholder, and you set up the corporation rather hastily, whether you did it yourself or you just wanted to get things going, and you did not add a spouse, you did not add a parent or a child as a shareholder. And at the time, when the practice is now worth $2 million, you want to say, okay, how can I add my children, or how can I add my spouse or parents as a shareholder? And it is possible. You go through a reorganization. You contact your lawyer and you contact your accountant and see what's involved. But the key here is you can't retroactively go back and say, well, I'm the initial shareholder. It's now with $2 million. I want to add my spouse or my parents as a shareholder. I want to be able to split that 50-50 and gain on that $500,000 of tax savings. That's not the case. You have to go through a reorganization and freeze. There's a terminology that you'll hear quite often is freeze or frozen value of the current shares. So the future appreciation can be attributed to the next owner. So if the existing shareholder had 100 common voting shares and the practice is worth $2 million, they'd freeze that $2 million worth of shares, exchange those shares for another class of preferred shares, and then maybe introduce a spouse or an adult child or a parent as a non-voting shareholder, so that anything beyond that $2 million is ultimately split between the next class of shareholders. So in this particular example, there's a sort of a few slides a little later where we take you through the numerical aspect of adding a shareholder. One of the pitfalls that we sort of want you to avoid by adding a growth shareholder is these corporate attribution rules. And it's ultimately where you reorganize your corporation and you are doing so where it's giving the transferor the benefit of transferring some of the value to the next generation or the spouse, and not trying to pay tax on the value of that transfer. So ultimately, if the value was $2 million and the spouse received additional shares of future appreciation, we have to make sure that we are well within the rules to avoid this corporate attribution. Otherwise, the existing shareholder would be hit with a deemed taxable benefit. So on that $2 million valuation, if the corporation went offside on the rules with the deemed interest benefits right now, and the prescribed rates currently with CRA are at 3% on $2 million, that's a $60,000 benefit that would be taxable to the existing shareholder. So you need to be careful to avoid corporate attribution where you can. There are ways that you can do it. Ideally, keeping your corporation relatively clean, and that term clean means that you do not start investing or having excess money built up into the corporation. You want to either pay out that amount as a dividend, potentially establish an associate corporation where you can transfer some of that money over. So you want to maintain that small business corporation status and keep your corporation clean, and that you have 90% of the assets actively working for you. So that means only 10% of the practice value. So in this case, if the practice is worth $2 million, you can't have more than $200,000 of excess cash or investments built up in the corporation. Otherwise, you'll fall into this corporate attribution trap. Move on to the next one. Our first question. All righty. So how much of an operating practice's assets must be related to the business upon sale in order to qualify for the capital gains exemption? 90, 10, 50, or 100? I think we'll give the participants 30 seconds or so in order to populate the answers. And if you were listening closely, just a minute ago, that answer was provided on the previous slide. So just in case you weren't awake, we're going to wake you up a little bit and make sure you answer the question. There's no testing or accumulation that's done. It's just as Jake had indicated, more so you qualify for your credits. All righty, Jake, do we have some of the results there?
Yeah, here are the results here.
All right, so we got a wide range, but the majority of you had said 90%, which is the accurate answer. So yeah, it's important to keep that corporation relatively clean. There are ways to reorganize those corporations. We have many clients that have come to us after years of practice. They've now had the ability to leave money behind in their corporations, have not added their spouses as shareholders. We have to go through a bit of a freeze and move some of the money across to another corporate structure, but that's another presentation in itself, or a come on in and visit our good friends at TMFD, and we can help you through that process as well. You can go off to the next one. So this is sort of the example that we talked about a little earlier, and this is giving you the visual view of it, where Dr. Smith owned DPC and had value of the practice worth $2 million. When we establish the freeze of Dr. Smith, he would then get the Class A shares. Then the future growth would be split up between Mrs. Smith, and Dr. Smith will have to own the voting common shares, as the dentist always has to have voting growth shares. And then Mrs. Smith will have the 98% or 98 shares of the non-voting common shares. So that future appreciation, as you can see in the next slide, where it's maybe 5 years later and the practice has grown in value to a $3 million level. So as we talked about the frozen shares on a future sale of 3 million, the first 2 million will be allocated to Dr. Smith, and then the balance of the $1 million is split 98 and 2% between Mrs. Smith and Dr. Smith. So that ultimately the Mrs. Smith utilizes a good portion of her capital gains exemption Dr. Smith utilizes his full capital gains exemption, still has to pay some tax because there is about $1 million that is not covered by the exemption. So total tax in the previous situation was $552,000, whereas on the reorganization and future sale, there's the $310,000. So as you recall from the previous slide, there was a savings of $242,000 simply by going through the reorganizational process. So well worth the implementation. Let's go on to the next slide. Now, we have a number of parents that want to help their children or want to be able to spread the wealth to the family members, and dollars or cash can be loaned to spouses or to children. When you have a spouse that's in a lower tax bracket and you have a spouse that's in a higher tax bracket, and that spouse has earned a majority of the income and has accumulated some investments, it's not as simple as saying, well, let's take that money and invest it in my spouse's name, whereas they are in a lower tax bracket, therefore they should pay tax at a lower rate. The CRA, our good friends, will see that as not the ideal thing to do and will attribute that income back to the original owner of the money, which was the spouse. So to avoid having that situation apply, and we'll run through a numerical example in a little while, you can establish a prescribed rate loan. So one spouse can loan the other spouse, say $1 million, and that spouse will need to pay the prescribed rate of interest to the lending spouse. Right now, the prescribed rate is currently 3%. With interest rates that have risen in the last little while, the prescribed rate from CRA's perspective has risen. Historically, it was at an all-time low at 1% and is now at 3%. And for those loans that were done even last year at 1% was even a substantial savings, because the individual spouse now has to report the income on that $1 million loan at 3%, or potentially on $1 million, $30,000. And the spouse who received the $1 million will then pay tax on the investment income. Assuming the investment income is 5 to 6%, then that individual will then be able to pay tax on, let's say, 5% or 6%, 50,000 or 60,000 at the lower tax rate. Whereas the spouse who lent the money would only pay tax on the 3%. Without doing the prescribed rate, the full 6% of the income would be attributed back to the lending spouse. So again, it needs to be documented. Repayment of the interest on an annual basis actually has to be made. It's not just a paper thing. It has to be physically made to the lending spouse. Well, one other, just before we get to the question there, Zach, it's not mentioned here, but there are a number of people that you have grandparents that maybe want to help out some of the grandchildren in their education. Maybe they're attending private school, or maybe they're needing some extra money, and grandparents may want to be able to help that minor child. Fortunately, giving a gift to the minor child will relate back to the attribution rules, and giving a gift to the parents can be done because gifts between adults is a non-issue. However, you never know once it goes to the parents if the intention is not to have it used for the grandchildren. It might not be the ideal situation for what the grandparents wanted. We'll talk a little bit about trusts in the next couple of slides, but ideally what the grandparents can do is set up a trust, loan the trust the money at the prescribed interest rate. The grandparents will have to report the income of the 3%. However, once the trust is established and the income is earned in the trust, that income can then be paid out to the beneficiaries, which are the children, at a lot lower tax rates and ideally likely not paying any tax because they're in the lowest tax rate possible. And there is no attribution because you introduce the prescribed rate loan. Maybe a little confusing, but maybe we'll show a numerical example afterwards. Question time. When a spousal loan is implemented, how long is the effective interest rate in place for? 5 years, 1 year, or the length of the loan? Only 3 choices this time. We're making it easier. Already, Jake, if you could help us out with the response. Ideal. It's the length of the loan. So as long as the loan is in place, the interest needs to be paid on an annual basis. On to the next slide, Zach, please. All right, so we get into the concept of family trust. I hear often a number of clients asking questions. What can I do? Can I shelter some of this money that I've earned? Can I put it in a trust? I hear of all my friends, or there's a lot of scuttlebutt amongst individuals talking about trusts and how they work, and can it be done to help save taxes? And there are opportunities, but it's not as simple as let's just set up a trust, throw money into it, and not pay any tax. That's not the case. An inter vivos trust, which is the most common trust that is set up while people are still alive. Trusts that are done when a person passes away are called testamentary trusts. Another name of another trust are alter ego trusts that are done when individuals are over the age of 65. But a common practice is setting up an inter vivos trust. And when establishing a trust, again, doing it properly and going through a lawyer, you need to have a settlor, you need to have some trustees and the beneficiaries. Ideally, you don't want the same individual to be the settlor, the trustee, and the beneficiary. Otherwise, CRA is going to deem it to be a bit of a hoax. So a settlor can be a grandparent that settles the trust with even a silver dollar. Trustees can be the parents, and even be the grandparents if you wish. And you can have more than one trustee. Ideally, if you end up having more than one, you want to make sure that the decision-making process isn't caught between 2 trustees, so that either you do one or you do an odd number so that you would have a majority rule situation. And the beneficiaries can be a number of people, can be children, can be spouses. Again, but you have to make sure of the things that we talked about earlier, and that if you are loaning the trusts some money, that the prescribed rate loans are done, and that the proper documentation is done. And one of the beauties of the ability to have the discretion of paying one beneficiary a certain amount of money and another beneficiary, another individual, can be paid a different amount. So it doesn't have to be even, and that the discretion is left to the trustee. So if you have a child that has maybe earned a little bit more money because they started working or worked a little bit more than another individual, then you have a bit of discretion on how you want to be able to split that. We can go on to the next slide there. So nothing here that's totally out of the ordinary, other than the potential of utilizing trusts to help with future estate freezes. Not so much more in professional corporations, because ideally trusts cannot be as shareholders of a professional corporation. So maybe if there are holding companies, or if there are other businesses that the family is involved in, then a trust could be established to help with the future growth of the company to the next generation, and introducing an inter vivos trust to help do that. So in this particular case, as we sort of talked about earlier, we're sort of using a smaller amount, but the $100,000 was lent to the trust by John Smith. Because it was lent, there's a prescribed rate loan, and that the payment of $3,000 needs to be paid to John Smith from the trust, and John will pay tax on it. Assuming John's at a relatively high tax bracket, he'll pay $1,500 in taxes. The spouse or the kids of the trust, who are the beneficiaries, potentially can receive the $6,000 of income paid to the from the trust to the beneficiaries, and if they're in a lower tax bracket, they would pay a little less tax. So you can see that there's an ultimate savings, mainly because of the different tax rates that are between the two. And to add one little more of a quiver here, and I think maybe this slide, unfortunately, could have been a little more edited on our part, but the $3,000 payment that is made from the trust to John Smith can act as a deduction against some of the income that was earned at the trust level. So instead of paying tax on $6,000, it actually being paying tax on $3,000. So that's a typo on our part, and I apologize for that. Okay, so how long is the lifetime of a trust? So I didn't give you the answer on this one. It wasn't in the previous slide. So hopefully this one is based on some reading that you may have done or you may have heard, but there is a lifespan to most inter vivos trusts. So is it 15, 21, or in place until the settlor passes? Wait for a couple of minutes here, and we'll see what the results look like. Jake, can you pop it up? So this one was not as easy, and unfortunately, the answer, in fact, is B. It's 21 years. There's a 21-year rule that needs to take place on most of these inter vivos trusts. And what ends up happening after 21 years, there needs to be either potentially a reorganization that's done, or the assets that are in the trust need to be distributed out to the beneficiaries. The beauty of the trust is that the distribution of those assets can be done at cost. So there's no tax to pay. However, the individual who then receives it would ultimately pay the tax on the future distribution or redemption of the money. So if there was $1 million initially, or $100,000 initially put into the trust, it grew to 500,000. That 500,000 would then get distributed out to the beneficiaries. There would be no tax on that distribution. The original $100,000 cost base stays in place. However, when the child or the spouse ultimately sells and utilizes the $500,000 down the road, there would be tax to pay at that time. We'll go on to the next slide there. All right, I'll get Zach, if you want to take over on the next part on pension splitting.
Thanks, Steve. So the next section obviously will be pension splitting. Obviously, this is something that will only be the case for retired dentists. However, obviously, most dentists end up retiring before the age of 65. What you need to know is that when you start to draw on your RSPs, when you convert them into RIFs, you won't be able to actually split any of that income with your spouse until the age of 65, unless it would be some sort of registered pension, such as a teacher's pension or any sort of large work pension. So what you can do is, with your RIF income, if you were to purchase an annuity, you can actually offload half of that onto your spouse. So if you were to take $100,000 in RIF income in the year, you can put $50,000, put it into your spouse's name. That way you both get taxed as having taken $50,000 each, rather than one person 100,000 and the other person 0. So you used to be able to do spousal RSPs. You can still do spousal RSPs, sorry, but obviously after the age of 65, the spousal RSP really doesn't offer you much benefit, because any income that you can take out of a RIF in your own name doesn't really yield much effect, because you can just offset most of that to the other spouse. But for dentists that happen to retire before 65, there is a window where the spousal RSP will offer you a great benefit, because during those years, obviously, you won't be able to offload any income onto your spouse. So it certainly, when you're planning these things in advance, it certainly helps to get advice, especially when you're trying to project out 15, 20 years to see where you're going to be and when you potentially can retire. So it's worth considering now, if you're in, let's say, your 40s, to see when you're going to retire and what the best strategy would be for when you make your RSP deductions or any sort of tax planning. And one last thing, this is obviously helpful with OAS clawback when you start to receive your old age security at age 65 or later. It starts to get deducted when you have when you declare income over 81,761. So really, you want to offload as much as you can. That's why spousal RSPs before the age of 65 will yield you a great benefit. And so, like I said, it really comes down to a pretty subjective decision between when you want to retire. If you're planning at age 59 to retire at 60 and you have never put anything to a spousal RSP, let's say you have a corporation, you don't have the wife on as a shareholder to yield any dividends from that, then you're almost kind of stuck in a box where you can't really offset any of your income towards your spouse. I believe we've covered everything else. And like I said, it has to be converted to a RIF. Any withdrawals that you do from an RSP, from just a regular RSP, won't actually count for pension splitting. So once you hit the point where you want to retire after age 65, then you should be converting to a RIF in order to both have the flexibility for tax withholding on the withdrawals, as well as being able to pension split for the spouse.
We mentioned one other additional thing there, Zach. Sorry, before you get into your question. The pension tax credit, I don't think we had mentioned it here, but that is about a $2,000 tax credit that's entitled to the individual if they are over 65 and receiving some pension income. So a technique that some people employ is, after the age of 65, they convert a portion of their RSPs to a RIF to generate at least $2,000 to $3,000 of RIF income a year, so that ultimately you can earn that pretty much tax-free, because you'll get a pension tax credit for the $2,000, and that can be done between both spouses. So a little bit of work to get $4,000 or $5,000 tax-free, but something that you can speak to your advisor about before the age of 71, before you are required to RIF some of your RSP dollars.
Mm-hmm.
Sorry, we had one last question, right, Zach?
Yeah, I think this is the last one. So, can your CPP payments be included for pension splitting purposes? Simple yes or no to finish it off.
Mm-hmm. All right, Jake, show us the results.
Yeah,
And
so
the answer is correct.
most of you got it correct. Yeah, the answer is no. So for a lot of dentists, primarily a lot of your income will be dividend income, as you take a lot of income out of your corporations in retirement. A lot of you might be seeing the only actual pension income that you get is CPP and OAS. So just keep in mind, for when you think about your OAS clawback, that the CPP cannot be offset and put onto the spouse. Okay. So just to recap all that we went through, obviously there's a lot of different techniques you can use. A lot of them may be situational, depending on what you want to do with how you structure your family, things like that. There's a lot of things to look out for. There's a lot of dentists that come to us and they don't realize that a spouse is not a growth shareholder on their corporation, and they come at 59, they want to sell their practice at 60, and their practice is now worth $2 million, and they're just finding out that their spouse is not a gross shareholder and they can't capitalize on their capital gain exemption. So it's helpful to get the correct advice, and it's helpful to have someone constantly monitoring the situation to make sure that these things are in place and that you're utilizing every avenue you can to share the tax burden between you and all of your dependents. Okay. So I'll turn it over to Chris.
All right, very good, guys. Thanks, Steve and Zach. You've definitely shown us that income splitting provides some very valuable ways to reduce the overall tax bill, but there are certainly some pitfalls to be aware of, and it's best to get professional advice in order to stay on side. So what we'll do at this time is we'll start questions and answers. And during the presentation, we did receive a few questions, so I'd like to go through that. And let me see here. The first question, Steve, is, does income splitting apply for a dentist couple? So I presume this means that both spouses are dentists.
Maybe not as much, because ideally, maybe both spouses are already claiming significant salaries, or they are splitting dividends. So from that perspective, the benefit really isn't as much. Maybe you have one dentist that isn't receiving as much money. You ideally want to be in a situation where both of them are earning a similar dollar amount, so that at least you are not having an inequity of taxes being paid. But I'd say lucky to the dentist couple.
I think it's certainly true that if there's a disparity in the income levels, that presents the opportunity for splitting. But if everyone's at the same level, then there's not much opportunity. So the next question relates to the capital gains exemption. And the question is that the LCGE, the capital gains exemption, only comes into play when the corporation is sold. And the second part is whether lifetime capital gains could apply to a corporation in which it's just an associate dentist, say one that doesn't own a practice. So timing of the LCGE on sale and whether an associate dentist can utilize it.
The LCGE only comes into play when the practice is sold. That is correct. So ideally, you can go through a restructure where you can crystallize and utilize your capital gains exemption, going through a bit of a freeze, but that's another exercise altogether. An associate dentist ideally would not qualify for the capital gains exemption, because an associate dentist doesn't really have much to sell, as they don't own a practice and there really isn't much value to their corporation.
Yeah, it's the sale of the goodwill, isn't it? That really is what you're getting to take advantage of. Similar question, Steve, is a freeze the same as crystallization? So it's really just a question of terminology.
Yeah, I would say they are similar in nature. The freeze is you're placing a value, you're freezing a value on the existing common shares. A crystallization, in the true sense, in the tax world, I guess, people see it as the ability to utilize their capital gains exemption and do a tax maneuver where you are not only freezing the value, but you're crystallizing the use of the capital gains exemption at the same time.
So I have a follow-up question to that, though, and that would be that, so you're going to go through this process of creating the freeze, but how do you know what value to use?
Mm-hmm. Well, I mean, we are asked that question quite often. There are, many evaluators that are out there, professional evaluators, CBVs, that you can, hire to do a value. There are a number of brokers that are out there that will offer you we'll call it a simple valuation that's done for tax purposes and not necessarily so much for sale, and it's a lot more reasonable price. But as most people know or may know, the value of practices have have dramatically changed over the last number of years, where the concept or the idea was, if it was 1 times your annual growth, that would be a reasonable value of what your practice is worth. A lot of it now is based on the terminology of EBITDA, which is earnings before taxes, depreciation, and amortization. So it's almost a profit figure, and a multiple of that profit figure will give you a rough idea as to what the value of your practice is worth. And that multiple can range from anywhere from 5 to 8 times, depending on the practice and how efficient it is running.
Well, it certainly seems really imperative that if both spouses or other family members hope to use the capital gains exemption, they need to be on as shareholders as soon as possible in order to capture the future growth. Right? I have a question for Zach relating to the spousal RSP concept. So let's say you have a situation where you have 2 spouses and one of them does have a spousal RSP already. Does it make sense to continue funding the spousal RSP, or should they just open a regular RSP?
At that point, it would just depend on when they're planning on retiring. Obviously, if they plan on retiring prior to 65, then obviously you'd want to continue to fund that spousal RSP, because even if you're to use the spousal RSP after 65, it can still be equalized between both parties. So you still get the benefit of prior to 65 and you get the benefit after 65. So ultimately, when you're thinking about these things 10 to 20 years out, it's something to consider, is the whole path there rather than just where we are now.
Yeah, agreed. As you say, it's kind of situational, right? Everyone has to be evaluated on its own merits. All right, Steve, got another question here. It says, my children are 15 and 16. Is it reasonable to pay them each $1,000 a month? And if so, do they have to file income tax returns at 15 and 16?
Go back to the reasonable test and $1,000 a month, and depending on what they do, I don't think this is an extraordinary amount of money. So $12,000 a year is, in my view, a reasonable amount. With regards to filing tax returns, I would suggest that a tax return be filed. A T4 will be provided to the individual. What it does do is it starts earning them our RSP room at 18% of the $12,000, so that ultimately when they start earning a better wage, they've built up some RSP room to ultimately be able to contribute to and get a deduction and use that when they make a bit more money. So by not filing returns, you're losing out on that benefit. And once you get to that age of 18 and closer, you start earning some HST credits and Trillium benefits and stuff. So you want to get in the regular habit of filing returns.
So I'm skipping ahead a couple questions here on my list, but it's related to this as well, where it's a child being paid, say, $10,000 a year. A T4 slip is issued, but can we wait until the child turns 18 to file the tax returns, or does it have to be done year by year?
I mean, I like the idea of filing it year by year, but I guess you can wait and accumulate and file them all at the same time, but you're individually filing for those years, retroactively, I guess, for the 4 previous years. But I think you should just do it over hand in hand. You get into situations where if you have let's say there's a marriage breakdown and then you have a child that is living with one of the parents and there is an equivalent to married, or there is a tax deduction that you're entitled to as a single parent, that single parent deduction is reduced if income is paid to that child. So if you don't file and you're paying them, CRA never knows and they still give you this credit. But then if you retroactively file for 4 years, you may be hit with a surprise and a tax bill for all those deductions that you had received in the past.
Well, if relations weren't good before, that would just create a better situation.
for sure.
All right, so another question. Can a dentist, after sale of his practice, who remains as an associate, split his associate income with his spouse? So for example, 40% associate income, 30% to the doctor, and 10% spouse ongoing.
I wouldn't say that the actual split that's being paid from the dentist is done such that it's paid 30 and 10. I would have the associate receive the 40% income and pay that into their professional corporation, assuming they are still utilizing the professional corporation. And then they can establish a salary from their own professional corporation to themselves, potentially, as well as their spouse, again, based on the reasonableness test. And when you're an associate, having many staff members, you just need to be careful. You're not going to have a parent and children and spouse on as salaried individuals or receiving an hourly wage. Again, it's depending on what they do for the associate.
I mean, an interesting twist on this is whether it could be written into a purchase and sale agreement, right? So that it almost entrenches that the other spouse has a job and can be paid.
Potentially, yeah, from the selling practice. That's an interesting way of looking at it. Maybe the associate income is reduced from 40% to 30 or 35, and have the spouse put on the purchasing practice's payroll. You're thinking outside the box, Christy. I like it.
Oh, it's
You're
one of our
trained.
creative guests.
You've been trained well.
Now, when assets of a trust are distributed to beneficiaries, what rules surrounding funneling the money back to the principal? I guess that's the original contributor. 7 years in an independent account. So I'm not sure I fully understand the question, but maybe.
Yeah, well, I'll be honest with you. I don't know the answer. I'm 7 years. I've never heard of that in independent account. I mean, unfortunately, the amount that's paid to the child will likely be in trust for the child if they're under 18, with the parents as a bit of a co-signing ability. But you just want to be careful and that you don't do too much commingling.
Yeah, absolutely. I mean, I know there's a situation where if you invest on behalf of a child, the income would attribute back to the parent, but what we call second generation income, where any future investments that are reinvested can attribute or accrue to the child directly. But that's getting into the details, isn't it? All right, next question. Is the lifetime capital gains exemption received on the personal side or corporation?
On the personal side. So when you're selling the shares of your corporation, you own the shares personally, so you receive the money personally. The corporation shares are sold to the purchaser, and you no longer own the corporation. So now you own the dollars personally. There's another question there. I think it sort of dovetails a little bit. Is a lifetime capital gains similar from an asset sale versus a share sale? Only on a share sale is the lifetime capital gains exemption. On an asset sale, you are not entitled to a capital gains exemption. You are entitled to a bit of relief in an asset sale. You have something called the capital dividend account, and there are a portion of the proceeds that could be paid out on a tax-free basis, but it's not at the same level of a share sale. We have one more question here. Can children be paid a salary only when they turn 14 years of age and above? Well, again, I use the concept of a reasonableness. I'm not sure how many 10-year-olds or 11-year-olds or 12-year-olds you see working outside. I mean, a number of us grocery shop quite a bit, and we'll see a number of young kids out there pushing the carts. And sometimes I wonder, they look like they're 12 years old or 13 years old. So, they're out there working. So I don't think it's unreasonable. Again, making sure you have duties and what they do. I mean, I have a dentist asked me, a little while ago, they had their, I don't know if I said earlier, but they had their 4-year-old daughter as they wanted to be a model for their practice and wanted to pay them a salary. But I think it was a little bit of a stretch. But 14 might be okay.
I wanted to go, thanks, Steve. I wanted to go back to that prior question. We were talking about the lifetime capital gains exemption, which is really a generous tax shelter, you might say, because with today's tax rates, it could shelter up to about $242,000 per person. Any thoughts that that lifetime capital gains exemption might be in jeopardy or the government might take it away?
I would hope not, Chris. Between that and the principal residence exemption, if they were to take those two away, it would pretty much destroy any future of what we built up so hard and long for as Canadians. That I think if they took the two of those away, we would be in a very, very bad situation. I know we want to pay back some of the COVID dollars, but I think those would be an ultimate death to the to the incumbent political party.
For sure.
Yeah.
So here's a creative question. I don't know if income splitting, how much this would apply. What is the best way to finance a $70,000 per year university fee for a child if money is in the corporation?
I wish I could tell you there was something that is unique. Up until a couple of years ago, it was, and the TOSI rules weren't there. The ability to pay out a dividend was something that was able to be done, and a lot of kids had their tuition fees paid for. I'll give you another quick story, again with my daughter who went to university as well. And she was a shareholder before the TOSI rules, and she'd be talking with her friends around the bar, and it was time for OSAP to come around, and they're doing the applications for OSAP, and everyone's asking questions. And they went to my daughter to say, "Hey, aren't you applying for OSAP?" And she's like, "No." And why not? I get some of these dividend things that help pay for my education. So previous to the rules, it was fine. But, again, income splitting, paying income to an adult child, I don't think 70,000 is a reasonable amount, but you could probably stretch it out, help out, maybe for 20% of it or so. If you can do some income splitting with a grandparent, and the grandparent can then gift the money to the child or to the adult child, that could help as well too.
It's always a challenge getting money out of the corporation for personal spending, right? Whether you pay through salary or dividend, at some point it's going to be taxable. It's really difficult to avoid the tax.
Yeah. We live in this beautiful country of ours. The unfortunate part is we do have a high tax rate. I think
we've seen a situation where that student actually was a dental student, right? And had enough qualifications that maybe they could be paid almost like a consulting fee.
Yeah.
But I'm not sure that would apply at the undergrad level.
Yeah. Another
question here. The question is, so to be clear, the sale of a practice applies only for the growth shareholders to get the tax exemption.
Yes. Yeah, because
again, why it's so important to get the growth shareholders on as soon as possible.
Yeah, for sure, absolutely. The characteristics of the growth shares and non-growth shares, if you ever look at your articles of incorporation, you probably have to dust them off if you've done them years ago, but they're worded in such a way that it talks about on future distribution or wind up or dissolution of the company, who's entitled to the value of the company, and those non-growth shareholders would not be.
Similar question with regards to growth shareholders. You alluded to it earlier that even children can be shareholders. So what happens if the practice is sold, the children, they actually get the money, and what happens if those children are minors?
Yeah, as I said earlier, when there was that question I was asked, I think that the dollars would have to be held in trust for the child. And as some of you are aware, the CRA has made some changes to the trust rules in that previous to this year, if individuals owned a trust and didn't have any income at that trust level, then there was no filing requirement. I think starting in 2022, the CRA is wanting to change those rules and wanting to provide a little bit more detail as to the ownership of the trust and the beneficiary. So the tax community is waiting on bated breath because the CRA has still yet, and we're almost in November, and they still haven't come up with the rules that they intended to happen in 2020, never happened in 2021, and potentially it may not even happen in 2022, but we'll see. All righty.
All right. Thank you. Thank you to everyone for your great questions. On the prior slide, we had a reference to the free book, the Financially Independent Dentist. In the book, it provides a framework to align your practice with achieving your financial goals. So in it, we ask 5 key questions to help reach financial independence faster, such as determining your financial independence target or FIT number, as we like to call it, or how I can make my practice work for me. So I hope you will enjoy it and contact us for additional guidance if you have any questions. The next slide, just wanted to let you know about our next webinar coming up. It's regarding cybersecurity and current record keeping in the dental office with Dr. Gordon Markeach. This webinar will cover the modern day issues and problems that dental offices face with networked information access. I think this one will certainly be interesting because of, how often do we all receive scam emails in our inbox, these phishing attempts, and even the prevalence of ransomware attacks these days threaten the security of all of our digital information. It really only just takes one wrong click to create a big problem. So it's really important to secure the network in the dental office to avoid unwanted attempts to break into your data. I'd say it's definitely a must-see presentation to learn more about protecting your important patient records. Now it's scheduled for Wednesday, November 9th, again, same time, 7 o'clock to 8:30. I want to point out our presentation tonight's a Tuesday, but this next one is in fact on a Wednesday. So feel free to register and visit our website for that. As we close up here, just a reminder that you are eligible for PAYCE credits, and our team will be working on that and send that out in the next couple of weeks. So as we close up for this evening, I'd like to thank our speakers, Stive Farronato and Zach Sloan, for their insights, and of course to Jake Giesler for running the show behind the scenes. And thank you to you, our guests. It's been really great to share the evening with you. We hope that you found it very valuable. If you have any questions about your own personal circumstances, feel free to send an email to info@tmfd.ca. Thanks again, everyone, and have a great night.
Good night.
Thank you.
Take care, everyone.